Hello, welcome to IG's Trading the Markets. Now that we're in the first few weeks of the year, for those of you hoping to ease into January, well, boy, what a ride it's been. And there's been plenty of excitement, not just in the Fed space, interest rates, indices tracking higher still as we speak. And also the geopolitics has kicked off as well. Joining me now to talk about all that is Aaron Bright, IG Assistant Portfolio Manager of our Smart Portfolios. It's been quite a year, hasn't it? Now that the dust has settled somewhat, if you can say that, how were you positioned coming into 2024, and how are you tweaking your positioning as we get all these data points and geopolitical headlines coming through?
Yeah, so thank you very much for having me, Angeline. So the dust has settled on 2023, and it's a year which, I mean, predominantly took us quite a lot by surprise. I mean, many of us were predicting some degree of economic downturn and sort of a recession, but obviously that didn't come last year. We saw a lot of strong figures on the economic and employment front. And stocks performed really admirably last year. So we saw the S&P 500 up around S&P 500 up around 25%. We saw the Nasdaq up over 40%. So we saw stocks really rally quite strongly last year, even though there were bouts of volatility. Remember the Credit Suisse debacle, there were periods of stress. But what's actually very interesting is a lot of financial commentators coming into the year were predicting a flat year for stocks. And if you look at the MSCI ACWI, which is a developed market global stock index, and you strip out all the Magnificent Seven, so all these firms, you know, such as Tesla, Nvidia, those type of firms, really tech-heavy firms, the performance of the ACWI was pretty much flat. So in that regard, the stock market was flat. And coming into the year, we sort of remain relatively neutral on equities. If you actually look across many of the sectors across the S&P 500, their 10-year PE is slightly above average. So going into a period where we've got high rates and valuations aren't too compelling, we aren't in a position to go overweight equities. So we remain fairly neutral towards equities.
In terms of regions, can you talk a bit more about that? Because clearly, as investors are trying to kind of gauge where to increase and decrease exposure, maybe it's a regional bias that they should be looking at.
Yeah, absolutely. So we manage a balanced portfolio, sort of very diversified portfolio across a range of risks. So we have exposures to all sorts of regions. We maintain a small home bias in the UK. We think certain industries in that could provide, you know, some positive performance, particularly if inflation continues to be a little bit of an issue. As we've seen, it is still annoyingly high around that 3.5% to 4% mark. And inflation seems to be plateauing a little bit, even though we saw some substantial disinflation. We have a decent position in Japan as well. We felt like the policy and valuations were very compelling there, so we have positions there. But our main position is, of course, the United States. Even though there is quite a premium you have to pay to buy US stocks, we still feel like the long-term trajectory for US growth and the US equity market is very positive. So that's where sort of the bulk of our equity exposure is. But we sort of maintain the view to have a balanced exposure, it's not exactly a balanced exposure, but a diversified exposure across a range of different geographies. When we manage the portfolio range, it's important to have exposures to all different geographies.
Now, we saw this Fed pivot at the end of last year, which sparked the Santa rally. Now there's a bit of recalibration going on. Many of the data points coming out still showing that the US economy is surprisingly resilient. And of course, we've got inflation pressures creeping back in again. Are you looking at all this and thinking perhaps we're not going to, as the CME Fed Watch tool suggests, not going to see this rate cut coming in March as the market predicts?
Yeah, absolutely. I would agree with that. How we've been positioning the portfolios is we do expect some degree of rate cuts this year, but we're sort of thinking more towards the second half. Something that we were discussing as a team recently was the inflation prints that have come out recently. And as I said earlier, inflation in the US and UK is still around that 3.5% to 4% mark. And it's really not an environment to be cutting rates in, even if the economy does fall over a little bit. It's almost against the Federal Reserve's mandate to cut in an environment where you still see inflation being particularly high. But with that being said, we still have tilted our portfolios in the fixed income bucket to have a little bit more duration, because we think when rates do come down this year, which we are positioning ourselves for, that those sort of longer dated bonds will have a nice rally, and there'll be some capital gains to be made within that area of fixed income.
And Aaron, clearly the Fed is probably keeping a close eye on what's happening in the Middle East as well. You mentioned concerns the last time we spoke about geopolitics, and since then we've had the Israel-Hamas war and also what's been happening in the Red Sea. How concerned about this are you, about this spreading?
Very much so. As we spoke last time, I was concerned about tensions in the region, particularly because of Iran's proxies and Iran vying for this regional hegemony. And we saw obviously a terrorist attack by Hamas on 7th October, where over 1,000 civilians were killed in Israel, and Israel has subsequently launched a military offensive in the Gaza Strip to remove Hamas's military capabilities. But we're seeing pressure all across the region. So we're seeing, I saw one geopolitical analyst refer to it as Iran's ring of fire, their proxies, which have the potential to cause all sorts of chaos within the region. So we have Hezbollah on the northern border of Israel, who are a prescribed terrorist organization. We have, of course, the one that's really catching our eye at the moment is the Houthis in Yemen, and they at first, I don't think many people were aware of their capabilities, but they're proving to be a real nuisance and causing some real problems in the Red Sea. So we've seen Eilat, the port of Eilat's business, fall 80% since the Houthi attacks in November. We've also seen a fall of 30% in global shipping traffic and container shipping traffic. And they're causing all sorts of problems in that Bab el-Mandab Strait. So we're seeing traffic through that strait become severely limited. And I was actually having a look at the maritime traffic throughout the Red Sea yesterday, and we're seeing ships putting on their destination saying, we don't have relations with Israel, or armed guards on board, because the situation throughout the Red Sea is actually so precarious that traffic is being diverted actually down through the Cape of Good Hope with enormous additional costs. And that can have quite significant ramifications for inflation if we see costs of imports going up for countries, and also if we see any form of supply chain disruptions, which could very easily get worse if the Houthis continue to cause chaos in the Red Sea. And with regards to the conflict developing, it really depends on how much Iran vies for this regional hegemony, because it can just call upon any of its proxies to attack Israel, which it sees as its biggest threat towards hegemony within the Middle East. So it's an issue we're very much keeping our eyes on. And prior to the war, the Hamas-Israel war, we actually added some gold and treasuries to our portfolio because they seem to be the safest assets in times of conflict such as this.
And staying on geopolitics, have the tensions between China and Taiwan caught your eye? I mean, how serious are your clients perceiving this, and should this also be factored in when looking at one's portfolio?
Yeah, really another interesting situation there. Whilst it isn't as intense as the situation in the Middle East, there are certainly tensions brewing there. So obviously China is quite keen to add Taiwan as a province to the sort of People's Republic of China. And we've seen over the past number of years, we've seen China ramp up military exercises in the South China Sea. We've seen almost like mock invasions of Taiwan being carried out by the Chinese army, sort of these amphibious style preparation drills. So Xi Jinping is certainly vying for some kind of invasion of Iran, whether it's militarily or whether there's sort of a peaceful solution there. China are quite convinced that they want this as part of their sort of overall nation. And what's so critical about that is the semiconductor production which comes out of Taiwan. So semiconductors are absolutely invaluable to many of our electronic devices, and Taiwan produced 60% of global semiconductors and over 93% of advanced semiconductors. So if there was a large-scale military conflict which occurred throughout Taiwan and China, then we could see huge issues with global technology, with economic development, and anything related to technological development. We could see some quite significant issues with regards to that. read recently that a CEO of a semiconductor company out of Taiwan actually said it could set the global economy back decades if a serious war were to outbreak between China and Taiwan.
Right.
So it's not our immediate concern, but it's certainly catching the eye.
Right, thank you very much. Really interesting stuff there. Aaron Bright, Assistant Portfolio Manager at IG Smartfolios, talking about geopolitics, how to position your portfolio in 2024, and also talking about Fed recalibration and why investors should be looking at perhaps going neutral towards equities as we start the year and indeed make a call as the Fed's intentions become clearer. This is IGTV, and I'm Angeline Ong.